Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Rive to receive the top 10 stocks to buy right now. Meta Platforms stock has been absolutely hammered over the last year. It's down about 75%, and the company's market cap is only $236 billion at the time that I'm recording. So what in the world has happened to this company? Why are investors so down on Meta, and what can the company do to get investor confidence back? Well, I think there's actually some relatively simple moves that they could make that could potentially double the company's stock. Now, Mark Zuckerberg has complete control of Meta, so he can do whatever he wants, doesn't need shareholder approval. Maybe he won't do these things, but if he does, I think there's a lot of upside in Meta stock. So let's get to what the numbers look like and how they might change with just a few changes in the business. I want to focus today on just a really simple analysis of Meta, and that's using the company's price to earnings ratio. This is a company that's highly profitable. This should be a pretty good metric for a company like Meta. A year ago, the company had a market cap of about $900 billion. And you can see here that the run rate of net income was about $10 billion a quarter. So figure $40 billion in net income per year, $900 billion company. That's a price to earnings ratio of 22.5. Now, look at the most recent quarter, $4.4 billion in net income. If we annualize that, give the company a little bit of a break, say $5 billion a quarter, assume $20 billion that they're going to make in net income per year. The company's current market cap of $236 billion is only a price to earnings ratio of 11.8. So not only has net income dropped over the last year, but the company's price to earnings multiple has dropped as well. That's how a stock drops 75% in a year, is both of those things coming down. So the question is, how can Meta improve either the multiple that investors are willing to put on the company or the earnings, the E in the PE multiple? And I think there's really some simple things that they can do to increase their earnings. Let's start by looking at revenue, because I think this is a business that gets a lot of pressure from investors, but has been pretty stable over the last 2 years. You can see that revenue kind of gyrates quarter to quarter. The fourth quarter is typically a pretty good quarter for Meta. That's because that's when a lot of holiday shopping is going on. But you can see that it's a pretty stable business from a top line perspective. So why is the bottom line down as much as it is over the past year? Well, there's really two things going on. One is the impact of ATT, or App Tracking Transparency, which is a policy that Apple put in place. What this did was really break the tie between clicking on an ad and knowing what that customer did at the endpoint for whether they're buying an app or some sort of good on a shop. So a company like Facebook or Instagram, what they're trying to do is put ads in front of people that they're going to click on and then make an actionable purchase. Using Apple's old technology, they were able to track that directly. And so maybe an advertiser would say, hey, we'll pay you $5 per converted click. So I don't care necessarily how many clicks I get. What I care about is how many people are actually buying the thing that I'm selling. Apple really broke that. And so now we're having to move to a case where companies like Meta are trying to determine how many clicks it takes to lead to a purchase. And it's just the data isn't quite as good there. So the advertising rates aren't going to be quite as high. So the margins aren't going to be quite as high on the advertising dollars as well. Meta's management said that ATT was going to have about a $10 billion impact on the business. And if you think about the margins that Meta has and the way that their business operates, that basically flows almost directly to the bottom line. So that's basically a $10 billion hit on the company's bottom line. And that's something that Meta just isn't going to get back. So investors are going to have to accept that. This is an impact of ATT. Not really a lot that Meta can do about that. So some of the decline in net income is from the ATT policy. Meta's responding by doing things like doing more machine learning and artificial intelligence, which will likely add value over time. But there was a hit to the company's net income. Now, the more interesting number and direct impact that we can see is this Reality Labs operating loss number right here. So this has been growing steadily over time. Right now, Reality Labs is losing about $15 billion a year based on the most recent quarter run rate. What does revenue look like for Reality Labs? Well, not only is it not very significant, but it's declining. Third quarter 2022 revenue, $285 million. Look at way back to Q4 2020, $717 million. So that's a huge decline. And if the metaverse and virtual reality, augmented reality is going to be the future, you would expect that people are going to be adopting this at a higher and higher rate, and revenue should be growing, even if you're not introducing a new headset every year. This is what's really disappointing for investors. And when you look at the amount of money that Meta is spending on, and Mark Zuckerberg has said that this spending is going to increase. So we're at $15 billion now. Next year, it might be 20, it might be $25 billion. And we simply don't know when there's going to be any sort of payoff from that. So it's worth thinking about, what if Meta simply either spun off or eliminated the Reality Labs business altogether? That would be $15 billion of operating income, probably between $10 to $12 billion of net income that would go to the bottom line. If we use the estimate of $10 billion in net income, if they cut Reality Labs, and then put today's 12 price to earnings multiple on it, the company could potentially be worth $120 billion more than it is right now. That's about a 50% increase in the stock. Now, would investors put a little bit higher price to earnings multiple on a company that isn't burning through $15 billion or more per year on Reality Labs? I think that's probably the case as well. So if we just say the company's run rate of earnings is $20 billion per year today, eliminating Reality Labs would be add another $10 billion to that, so $30 billion in net income. And then investors give a little bit higher price to earnings multiple of 16. That's still lower than the market overall. That's how you get to Meta stock doubling with just one simple move, and that's getting rid of Reality Labs. Now, to be clear, Mark Zuckerberg doesn't need to do this because he has complete control, complete voting control of Meta stock. So he can basically do whatever he wants. As investors, we're just along for the ride. But this is one of the reasons that the stock is beaten up as much as it is because investors are saying maybe this isn't the right company to be building virtual reality hardware, the metaverse. Maybe somebody else should be doing that. And what I would be worried about if I were at Meta is there doesn't seem to be a lot of momentum behind the VR and metaverse products from a revenue standpoint. I mentioned early on that revenue is actually declining over the last couple of years. So why would you be pouring more and more money into this business? It just doesn't seem to make a lot of financial sense. Now, maybe the metaverse will be a big thing in the future. Maybe VR and AR will be as well. But that doesn't necessarily mean that Meta is the right company to be building this. I think that's what investors are really concerned about. I would actually argue that smaller companies should probably be building a lot of this hardware and software because they're going to be able to iterate and learn more quickly than Meta is. Meta is trying to build this massive metaverse, put tens of billions of dollars into this, and then assumes that customers are going to have demand for that, but they haven't proven out that there's demand in the first place. So there's a lot of questions that Meta is facing, but I think when you take a step back and look at the valuation of the stock today versus where it was a year ago and the amount of money that they're spending on this Reality Labs division that really shows no signs of providing any sort of operating income in the near future, this is a stock that I really think could increase 50% to 100% just by eliminating Reality Labs, whether that's a spinoff or shutting it down altogether. Again, I don't think that Mark Zuckerberg is going to do this because he doesn't have incentive to do this. But if you're an investor in Meta, that's really one of the upsides. If they start talking about cutting back on this spending, the stock could shoot higher. And that's one reason to be bullish on Meta stock. So what do you think about Meta stock? Does Mark Zuckerberg have the right vision of the future of VR, AR, and the metaverse? Leave a comment in the comment section below. Give this video a like, and of course, subscribe to the Rive Project. I'll be covering disruptive companies on a regular basis, and Meta is definitely one to keep an eye on. Thanks for watching, and I'll see you again here next time.